Greetings of the day. My name is Lakshman Jajodia, and in this video lecture of Business Finance Second, we will continue with our previous topic which we have started from unit number 3, that is non-banking financial companies. In this particular video lecture, we will move to what are the various different types of non-banking financial companies or finance companies. On the basis of non-banking financial companies can be distinguished into two types. On the basis of first one is on the basis of their activities, and second one is on the basis of they accept deposits or not. So the very first is on the basis of nature of their activity or which activities are that particular NBFCs are going through would be the first classification under the head of types of non-banking finance companies. The very first is assets finance company. So according to RBI, any non-banking company can act as an asset finance company on condition that income arising from the aggregate physical assets supporting the economic activity should not be less than 60% of its total assets and income. It means that there are certain conditions or rules and regulations which are to be followed by the NBFCs to get classified as assets finance company. The primary condition is that whatever the income is arising from the aggregate physical assets supporting the economic activity should not be less than of its total assets and income. It means that it should form a part of 60% of its income, total income. Only then it can be classified as the assets finance company. This is the very first type. Second is loan company. So loan companies under NBFC provides loan and advances for working capital finance. A finance company would only be considered as loan company if their 50% of total assets are in the lending and 50% of total income arises from the assets which are lent. It means that a company would be classified as loan company only if it provides loan and advances for working capital finance. First thing. Second thing, that finance companies or that NBFC should get 50% of its total assets in lending and its 50% of total income should be from that lending lend assets. It means that 50% of income should be from that particular business of lending and only and 50% of its assets should be form part of its lending, then only it can be classified as an loan company. This is the second type under the heading of nature of activity of NBFC. Moving to the third one is investment companies. So an NBFC company can be called as investment company whose main business is managing and holding securities for investment. These companies invest funds on behalf of their clients who in return expects to share the profit and losses. It means that a company can be registered as an investment company under the NBFC only if its primary business activity is managing and holding securities for investment. They can be doing this for the part of their clients who are expecting that they would the NBFC would generate good returns and share profit and loss with us, then only that investment company would be classified as that NBFC would be classified as investment company. Next is core investment companies. So what is the difference between investment company under the NBFC and core investment company? So the core investment companies are again NBFC doing the business of acquisition of shares and securities, and they hold 90% of their assets in form of bonds, equity shares, preference shares. It means that in the prior part we are doing on behalf of our client, but in this part we are doing it for ourselves. That is why the condition what is led to be an core investment company, that 90% of our assets are held by us in form of bonds, equity shares and preference shares. Then only we would classify it as core investment company. In the earlier part we were providing certain service, but in this part what we are doing, we are being the part of that particular investment strategy. That is why we are not able to, we are holding that security, then only we can be classified as core investment company. What is the percentage which we require to become core investment company? The percentage would be as high as 90% should be with us. Then only we would be core investment company. Next is infrastructure finance company. So when a company, when an NBFC can be an infrastructure finance company, only when, as the name suggests, it would provide funds or loans for infrastructure development. So what is infrastructure? Development of transportation facility, water and sanitization, energy, communication, social and commercial infrastructure. All these things forms the part of infrastructure, and hence when an NBFC provides finance for the purpose of these infrastructural things, then only it can be classified as an infrastructure finance company. Next is microfinance company. So what is a microfinance company? This is the one of the major development which is being done with relation to the microfinancing in all over the globe also, and we can particularly say about India also. So first of all we would understand, then we would discuss. So microfinance companies are those financial institutions which offers small scale financial services in form of credit and savings to poor in rural and semi urban areas. Microfinancial services are usually made to help them in economic activities, increasing their services, supporting self empowerment. Microfinance company is a non-deposit taking firm regulated by Reserve Bank of India Act 1934. What does it mean? It means that these are those financial institutions which are working in the rural and semi-urban areas for the financial upliftment of the poor or the low income group people. First of all, what do the microfinance companies do? They again try to mobilize the saving of these people and then also give the services of giving credit to them. The maximum ceiling of giving loan to any member of microfinance companies would be 50,000. It is popularly known in our state as GAT, बचत गट जो कहते हैं, that would form a part of microfinance companies. So why do microfinance company exist? It exists because they helps in the economic activities by what we can say, by increasing the saving of the poor, low income group people, and also help them in supporting them with the self financial empowerment. They are needed to be registered with the under the RBI Act 1934. Then is the housing finance companies. So what are housing finance companies? They provide main, the housing finance companies have mentioned house finance as their main clause in its memorandum of association. It means that those NBFCs which is engaged primarily in housing finance, they would be classified as housing finance NBFCs. So NBFCs have completed commercial have complemented commercial bank in providing mid-term capital loan to individuals or firms. These are advantages of being an housing finance company. They are more flexible, their rules and regulations are less stringent, which gives them competing edge over commercial banks in providing the housing loan. So they are now competitive atmosphere has been made with the commercial bank of the NBFCs providing housing finance to the needed or what we can say interested parties or interested customers or individuals or firms, with providing mid-term capital loans with greater flexibility and less stringent rules, which gives them an extra edge over the commercial banks, and that is why the business has become more competitive in case of housing loan. Next is on the basis of deposits. We can classify first of all on the basis of what we can say nature of activity. Hence each name of that type will suggest what type of NBFC it was. Now on the basis of accepting the deposit or on the basis of deposit, first company is deposit accepting NBFCs. So when an NBFC requires to accept the deposit, they must compile and register themselves with the RBI as per the rules and regulations laid down in the RBI Act 1934. NBFCs before incorporation need to register themselves with the companies, which we have discussed in the earlier video lecture, and obtain the certificate of registration from RBI as an NBFC. If it accepts the deposit from public, they need to follow the particular additional regulations and guidelines as and when prescribed by RBI. We have seen in the last segment of previous videos that there are certain regulations issued by RBI for the NBFC, in which deposit related regulations were also there, and that is why if a company wishes to acquire the deposit or to accept the deposit from the public, what they need to do, they need to register with the RBI and follow all their rules and regulations, along with registering with the Companies Act 2013 and 56 after getting incorporated. Second type would be non-deposit accepting NBFCs. So the only difference between the earlier one and this type of NBFC is that the earlier one accepts the deposit, whereas the next one does not accept the deposit. Hence, they do not need to follow extra guidelines after registering themselves of RBI. When we accept the deposit from the public, there is greater autonomy, there is loss of our autonomy and greater control of RBI on us. But as an NBFC, when we decline to accept the deposits, there would be less guidelines to be followed by us. These are the various types of NBFCs, and here we sum up the topic of NBFCs. From the next video lecture, we will start the second topic of our unit number 3, that would be credit rating. Until then, stay tuned. Thank you.